market went down last week, yet don't buy the dip. Hello everyone, this is Ahmed Saleh and this is a weekly market recap. And now to the key messages. So during the last week, we have the long-awaited profit taking. The trigger was the China tariff escalation, yet the taco trade didn't happen this time. So if you recall, during the past period, whenever Trump was coming out with these announcements, the market didn't believe him and the market was going up. Yet this time, this is not the case. The market went down with this news and it didn't rebound. So it looks like that this is not the main reason. What I'm thinking is that the market was due for correction and the market just took this as a reason to go down. I always say, don't buy the dip, buy the strength after the dip. So watch out for a strength in the coming period and then you can go to the market again. We are starting the results season next week. This can have a say on the market direction. My recommendation is just to take a few days off. You don't have to be in the market all the time. Just take some time off. We talked last time about this year and we said that this year is not following the 10-year median return. We talked about OND is the strongest quarter in the year, but we said we have to be open on what the market will give us because this year is not a normal year. And this is what happened. So the start of OND was not in line with the history and the market went down by 2.4%. We also said that the valuation of the market is very high and we said that we will take this as a guidance. This will not prevent us from going in the market until the market is telling us otherwise, and this is what happened last week. We also said that the stock market has high valuation. If you look at it in the BE, in the forward BE, in the pillar BE, whatever matrix you look at, we said that the market is very high in terms of valuation. But we said that this will not prevent us from going into the market until the market is telling us otherwise, and the market told us otherwise last week. So last week we had minus 2.4% in the S&P, minus 2.5% in the Nasdaq, and the equal weight and the Russell went down by more than 3%. Actually, last Friday was the worst day since April. That was because of the escalation that Trump did with China regarding the tariff. And this time the taco trade didn't happen. So Trump didn't chicken out yet. We don't know if this will happen next week or not. So watch out for this. The government is still in shutdown and there is no job report, but this is not affecting the market. I think the market was due for correction. We were going up since April until today. It's almost like 6 months without almost any correction. So the market was due for a correction. One thing to notice is that the number of companies below the 50 days moving average and below the 200 days moving average is more than 50%. And the number of companies below the 50 days moving average is more than the number of companies below the 200 days moving average, which means that the short-term direction is for the market to go down. So if you go to last week's video, I talked about the 21 days moving average, which was at that time at 6,620. It went up during the week, and that was my exit point. So I exited all my position last week, except the gold and silver, as we will see later on. Now, where can this take us? Normally going down by 5% is happening like 3 times a year. So on average once every 4 months. So we didn't have one since April. So it is time to go by at least 5% down. We might stretch that to 10%. And the 10% is normally happening once a year. Last time it was in April. So we are not due yet for 10% correction. But who knows, maybe it happens. And don't be surprised if we opened Monday and the market rebounded. That can also happen. Anything can happen. Just be ready for whatever the market is going to give you. For investor, I would suggest that you take profit at 50 days moving average. Some textbooks suggest that investors should always be investing. You should not go out of the market. This is not my school. This is not my strategy. I don't see any reason for someone to take 10% hit or 20% or 30%. If you know the market is going down and you know it is crossing the 50 days moving average, go out and then go back again whenever you see the market going back again. Next week, we'll see the news on the government shutdown. It's not affecting the market as we mentioned before, but there are some reports that is very important to see and they are not coming out, like the CPI, like the unemployment report. They are delayed. So we need to see if they are going to happen or not. Next week as well is the start of the results season. So we have few companies that will announce results. So we have BlackRock, Goldman Sachs and Citibank and Wells Fargo, Johnson & Johnson, Domino's Pizza. They are going to announce on Tuesday. before the market opening. On Wednesday, we have ASML and Morgan Stanley before the market, and after the market, we have United Airlines. And then Thursday is an important day because we have the TSMC, the Taiwan Semiconductor. So this can give us a clue on the direction of the technology sector. And after the close, we have Interactive Brokers. And on Friday, we have American Express. My trading strategy is very simple. Just stay out. When you see the market going through some volatility like the one that we are in, just go out. It's okay to take a few days off. You don't have to be in the market all the time. Just go out and watch the market. And if you see the market going down and you still want to be in the market, you can start shorting the index or start shorting some stocks. Now let's look at the stocks that I recommended in the past few weeks. So STX, we always said that if the 21 days moving average is far away, just take the 10 days moving average or take another support point, a closer support point if this was far, and this is the case here. So the exit point here was at 250. You had several chances to go out. If you didn't go out at the 250, you could have gone out at the 10 days moving average or the 21 days moving average. Now you can go out at the 214 if you are still in. Since we recommended this stock, it did about 33%. Very nice in 4 or 5 weeks. Next one is GDX. Again, the same strategy, going out at the 10 days moving average and 14% in the last 4 weeks. Next one is AGC. Again, the same strategy. And this, when you have a support that is meeting the moving average 10, this is a good support. And you can see stock is going down very easily throughout this. It's now stopping at the 21 days moving average. So if you didn't go out at the 25, you can go out at the break of the 24. Next one is gold. I'm still in gold. It went up by 3.1%. There was some volatility on Thursday because of the news on the Middle East peace treaty. It went up again on Friday because of the turmoil that is happening in the market. So I'm still in gold. Next one is CrowdStrike. It didn't cross even the 10 days moving average, but you can see it's a very bad candle. It hit the resistance at 515 and then went back again. It was a very bearish. So I went out of the stock with 15%, not bad at all. Next one is Grail. In the last week video, I mentioned that if you get a red candle after this inverted hammer, then it's a bad sign. So I went out because I didn't want to risk that. It reversed from the support at 61 and it's going down again. So now you have a chance to exit at the 10 days moving average if you are still in. The profit was 73% in a month, not bad at all. Next one is Sound. Sound, again, I didn't want to risk, especially with such condition in the market. We talked about the overhanging supply, and clearly the overhanging supply here is preventing the stock from going up. So I'm taking the profit. I'm going out with 27%. It's not bad at all. Next one is Rocket Lab. We talked about the cup and handle and the double bottom here last week, and the stock went up. But on Friday, we had a very bad candle, again, going down with the market. So there is no need to risk that. Just go out and get the 20% profit in 3 weeks. Next one is AppLovin. We talked about App and we said that we are going out at the 10 days moving average. And we said if the 21 days moving average is far away, just look for a support or look for a moving average that is close by and go out when it's crossed. And that's what's exactly happened on Monday. We had some bad news that the company is under investigation. So there is no need to be in the stock. You go out and you preserve your profit at 16%. Next one is KWeb. KWeb is the China Internet ETF. It went down because of the news on Friday, but even before that, it crossed down the 10 days moving average at 21 days moving average and the support at 42. So you had a clear exit signal at this point. So you should have gone out with a profit of 4%. The next one, which we talked about last week, was the iBit, which is the ETF following the Bitcoin. It was a false breakout. The Bitcoin didn't manage to stay above the 69 and the 70, and it went down directly. So there is no need. When you have a false breakout, you don't need to stay much more in the stock. You just go out. You don't need to wait for the 21 or 50 days moving average. If you want to wait, that's fine, but you don't have to because you entered into the stock because it crossed up the 69. When it crosses back the 69, then you should go out. Next one is silver. Silver, I'm still in. It is doing great, going up by 4.3%. We had some volatility during Thursday because of the announcement of peace treaty in the Middle East, same as gold. If you got out during that day, there is no problem. You can go in again. I always say there is no problem at all if you got out of the stock to go back again if it continued to go up. Last one is the XLV, the health sector. It was a false breakout, same as IBIT. It didn't break out the 145 and it started to move sideways and then down on Friday. So there is no entry here. That's it. Thank you very much. If you like the video, then please press like, share it with your friends, subscribe to the channel, and put any question in the comment. This video is for educational purpose only. Any trade you make is at your own risk. Thank you very much. This was Ahmed Saleh.